There are a lot of fascinating things that I learned when I got my life insurance license, many of which made me regret not getting a life insurance policy in my 20s. But the most interesting thing that I learned wasn't about life insurance at all, it was actually about banks. First thing that I learned is that banks are only required to have 10% of the funds that are deposited with them available liquid. The rest, they're able to make more money with it. What that means is if you have $10,000 in your savings account, your bank is not required to have that $10,000 to be able to give it to you directly. They're able to take $9,000 of that money and use it to make more money. Of course, we know about credit cards and personal loans and mortgages. My initial thought was, okay, cool. So I guess they're taking their money and they're using it to make loans. Makes sense. But that is actually not where banks are putting most of their money. They're taking your money that you're putting into your savings account and they are taking that money and parking it in life insurance policies. Now, they're not taking this money and parking it into a regular policy. They're taking this money and putting it into cash value life insurance. So how much money could banks possibly be putting into life insurance? The bank that owns the most cash value life insurance is Bank of America. They have $24 billion parked in cash value life insurance. Yes, my friends, that's billion with a B, okay? Why would the bank take your savings and put them into life insurance? That is the question. Well, life insurance companies, unlike banks, are actually required to keep all their cash on hand. So if they are supposed to pay out $24 billion if somebody dies, they need to have $24 billion in their books liquid to pay that cash out. Essentially, life insurance companies are more regulated and they are required to have all your cash on hand. So they cannot afford to do anything risky with your money because they need to have that money available in case you're to pass away tomorrow. Let me ask you a question. If a bank thinks it's safer for them to put their money in a life insurance policy, where do you think you should be keeping your money? Go ahead and share your thoughts in the comments. Here's how this works. Whenever funds go into a cash value life insurance policy, the funds are split in two ways. Part of the funds go towards paying for life insurance and the other part goes into a cash bucket. Now, there are different types of cash value life insurance policies, but some of these policies, the amount that's in the cash bucket is going to earn interest depending on how well the stock market is doing. Okay, cool. If the money is tied to how well the stock market is doing, then why wouldn't the bank just put their money directly into stocks instead? Why would they put it in a life insurance policy? There are a few reasons why they would rather put it in a life insurance policy versus putting it in the stock market directly. One, we know just basic finance is the best place for your money to grow in the stock market. It's also a risky place because if it's a bad year, your money's going to drop as well. If their money is in the stock market directly, on years where the stock market performs poorly, then they are going to lose money. The beauty about putting your money in a life insurance policy that is tied to the stock market is when the stock market does not perform well, your money never goes below zero. So if your year starts out, you have 30K in your cash bucket, the stock market crashes, your money will still be 30K. You're not going to see a dip in your money. So essentially, the banks get to have a win-win situation where when the stock market is performing well, they make a whole bunch of money off of your money while you get a tiny sliver. And then on years where the market does not perform well, they keep the money. They don't lose anything. Second reason, the more important benefit, in my opinion, to put their money in a policy as opposed to in the market directly is that for tax purposes, life insurance is not treated as an investment. For tax purposes, life insurance is life insurance. So even though they are making money, even though they are getting interest, all of the interest that is gained in that policy is not going to be taxed. But meanwhile, any money that you have in the stock market directly, including money in your 401k, is absolutely going to get taxed by the IRS. Now, in addition to knowing their money is 100% liquid because insurance companies are required to have all the cash on hand, in addition to knowing that they're going to have their money growing as if it's in the stock market, but knowing that it's 100% protected if the stock market crashes. And also knowing that every single cent that is going to grow in this policy is 100% not going to be taxed or touched by the IRS at all. Let's just take a moment to remember that Bank of America has $24 billion in life insurance policies. So just imagine if the stock market goes up by 10%, they get 10% interest on that $24 billion. How much money are they making every single year tax-free because they know about this money hack that we never learned about in school? And the cherry on top is that whoever's body is insured in these life insurance policies, if that person happens to pass away, then they're going to get a large chunk of cash for that person as well. So they get to have a cash payout if this person that is insured passes away. They get to have money growing exponentially faster than if they put it anywhere else. They also get to have money that is 100% safe because insurance companies are required to keep all that cash on hand. And they also can have every single dime of that money 100% tax free. Whether that cash is cash that is growing in that cash bucket or it is cash that comes after that person passes away, all that money is 100% tax free. So now that you know about this, what can you do with this information? The beautiful thing is cash value life insurance is not only for banks. Regular people can get this as well. You do have to apply. It does not get given to anybody, but it is something that is very doable, and you can use this account to save up for extra retirement income, to save up to buy real estate, to save up for a business, all kinds of things. You get to decide what you want this account to do for you, but most importantly, you get to cut the middleman, which is the bank, and actually maximize how much your money is earning every single month. Some of you are going to take this information that you just heard and change your financial future drastically, while some of y'all are going to keep complaining, keep scrolling, and in a few years be in the same place that you are today. In this video, I walk you through actual numbers of what this account could do for you. For those of y'all that know what you actually want for your future and you don't want to be like Uncle Jimmy down the street that's complaining and whining and not changing what they're doing about their life, I'll see you in that video. Take care.